Welcome to this investment webinar. As many of you are painfully aware, between late 2007 and early 2009, the Australian share market fell by 54%. Now, why did it fall by such a large amount? The second largest fall in the Australian market's history. The answer many of you would rightly give is that we had a global financial crisis. Countries and economies and companies had become too highly indebted. This was highlighted, of course, by the US property market failing. Again, that was fairly characteristic of many of the same conditions that applied to many of the developed economies around the world. As the global financial crisis progressed, of course, unemployment was expected to rise, GDP growth was expected to fall, many companies were expected to, and some indeed did, go into bankruptcy. But when you look at all of these fundamental factors, had they deteriorated by a factor of 54%? And of course, unemployment did not double, the dividend yield of shares had not halved, the size of economies had not halved. And so when you look at the fundamentals, they might have deteriorated by an average of, say, 20%, and yet the market fell by 54%. Now, why did it fall by so much more than the fundamentals might have indicated? And that's the topic of what we're going to look at in this webinar. The psychology of the market. It's the psychology of the market that causes markets to overshoot, both on the way up and on the way down. So that's what we're going to look at in this webinar, how to keep your head while others around you are losing theirs. Okay, so before we go on, we just need to go through this disclaimer. The information contained within this webinar is general advice only. However, if you would like personal advice, please take up the opportunity to schedule a free consultation with myself, which you can do so just by ticking the box before or after this presentation. Okay, now we've covered our compliance aspects, let's get stuck into this webinar. Okay, so during this webinar we're going to play an investment game. In this investment game you're going to have the choice of investing in two different assets, either widgets or gadgets. Basically the game will run for 3 years and you need to choose which one of those two assets you are going to invest in for each year. You can only invest in one each year, but at the end of each year you do get the opportunity to change if you like. Throughout the game we'll be interrupting it from time to time with various other little case studies, again just to demonstrate the impact that emotions have on our decision making. So first up we've got widgets. So widgets are an asset class here that have got a very good short-term return history. Both in the last 5 years and the last 2 years we've got an average annual return of 20% per annum. You heard about widgets from a friend who'd been invested in them for the last 5 years and was raving about how good they had been. Not only that, but you've also recently read in the local newspaper that they come highly recommended from a high profile investor. Your second option is gadgets. They have a 100-year average return of 10% per annum. Over the shorter term, however, they've lost 15% per annum both of the last 2 years. In addition to which, you've read recent newspaper articles claiming how the days of gadgets are numbered and the performance history of gadgets is likely to be pretty ordinary for the foreseeable future. So which one are you going to choose, widgets or gadgets? Before we go on, give some thought to those statistics and choose which one you would prefer to invest in. So before we go on and have a look at how your asset went for the last year, let's have a look at a little experiment. Most of you have probably heard the term herd mentality. What we have here is a fantastic experiment that was conducted by some psychologists into the power of the herd mentality. So basically what they've done is they've got 10 individuals in a room and asked them a very simple question. Questions such as, what is the capital of Australia? Is it A, Canberra, B, Darwin, C, Perth? However, in this experiment, they've instructed 9 of the individuals to mostly answer incorrectly. And yet the poor purple person isn't aware of what's happening and is there left to answer for whatever they think is the right answer. And what they found was that a third of the time, faced with a whole group of people answering the seemingly incorrect answer, the purple person capitulated and went along with their answer as well. They've also done a modified experiment where instead of everybody being in the same room, everybody just had to press a buzzer, so they knew what the answers the other people had given, but they couldn't see them. And so what the psychologists deduced from this was that herd mentality has a big influence. In the first experiment, it could be deduced that the purple person was simply concerned about looking the fool in front of all the peers and answering a different answer. But in that second experiment, where they couldn't see the other individuals, it can only be deduced that the person simply thought that all those other people could not be wrong. And so despite being quite certain that Canberra is in fact the capital of Australia, they rather go along with the rest of the public opinion. And so this is quite powerful when we look at what that means to the share market. In this example, the answer to the question was seemingly straightforward, and no doubt the person giving the answer was pretty confident that Canberra was in fact the answer. However, in the share market, nobody is that certain of the answer. And at any one time, there's always going to be some conflicting opinions as to which way the market is going to go. And so you can imagine in a share market, even if you think that perhaps the market is overvalued or it's not a good time to invest, if the rest of the public is wholly and solely supporting the share market and saying how good its prospects are, it can make it very difficult to go against this public opinion. And so bear that in mind whenever you are perhaps listening a little too much to what the public opinion is saying. So before we go on and have a look at how you've gone in that game, just bear that in mind, that herd mentality matters, and it can mean that people will follow along with a decision that they don't necessarily agree is correct. Okay, so let's get back into the game. So you should have chosen now what you wanted to invest in for that first year of this investment game. Are you going to invest in widgets or the gadgets? Okay, so here we have it, the results for year 1. Widgets, a nice positive return of 20%, perhaps exactly what you were expecting after all. That is what they have returned for the last 5 years. You'll probably ring up your friend and have a good chat about how well the investment's done and thank them for letting you know that it was a good idea. And gadgets, minus 20% return, ouch. Gosh, on top of the other negative returns, that's really starting to hurt. Not only that, but in the world within which gadgets operate, you suddenly read the following newspaper articles. There is a world meltdown, there are global recession fears, Wall Street has slumped, certainly not a rosy picture. So before we go on and have a look at another experiment, again, just think about some of the emotions that you're experiencing and give some thought to perhaps what you want to invest in next year.